Chapter 5, Policy Provisions, Riders, and Options. The entire contract includes the policy plus a copy of the application. The insuring clause is on the first page. It details the insurer's promise to pay, the risk insured, the amount of coverage, and the premium. Consideration involves the premium and statements on the application versus the company's promise to pay. As the owner, I have rights to choose and change beneficiaries, assign the policy, select premiums, surrender for cash, and receive dividends. There are two types of assignment: absolute, which is a permanent transfer of all rights, and collateral, which is partial and usually temporary for a loan. In California, the free look period is 10 days for a standard new policy and 30 days if I am 60 or older or for replacement policies. Payment of premium details when, how, and to whom it is made are crucial. The grace period is typically 30 or 31 days to pay a missed premium, during which the policy stays in force. If my policy lapses, I can reinstate it within 3 years by providing proof of insurability, paying back premiums with interest, and repaying loans if required. Surrendered policies cannot be reinstated after they are surrendered. Incontestability means that after 2 years, the insurer cannot void the policy for misstatements, except for fraud in some states and misstatements of age or gender. If there is a misstatement of age or gender, the benefit is adjusted to what the correct premium would have bought. Common exclusions include certain aviation activities, hazardous hobbies, and sometimes war. The suicide clause states that if I commit suicide within the first 2 years, there will be no death benefit, but premiums are refunded. After that, the benefit is paid. Beneficiaries are categorized as primary, who is first in line, and contingent, who receives the benefit if the primary dies before me. A revocable beneficiary can be changed any time, while an irrevocable beneficiary cannot be changed or borrowed against without their written consent. The common disaster clause assumes that if the insured and primary die close together, usually within 14 to 30 days, the primary died first, so proceeds go to the contingent beneficiary. The spendthrift clause protects proceeds from the beneficiary's creditors when paid in installments. Policy loans are available only on cash value policies, and the loan plus interest is subtracted from the death benefit if not repaid. An automatic premium loan uses cash value at the end of the grace period to pay the overdue premium automatically and keep the policy from lapsing. Riders are add-ons to the policy, such as the waiver of premium, which waives premiums if I become totally disabled after a 6-month waiting period, usually ending at age 65. The waiver of cost of insurance for universal life waives the cost of insurance, not the full premium. The disability income rider pays monthly income to me if I am disabled and waives the premium. The payer benefit rider on a child's policy waives premiums if the payer, usually a parent, dies or becomes disabled until the child reaches a certain age. The accidental death rider may pay double or triple the face amount if death results from an accident within a stated time, usually 90 days. AD&D also pays a percentage of the face amount for dismemberment. The return of premium rider returns all premiums paid plus the death benefit if I die before a certain age. The cost of living rider increases the face amount to keep up with inflation, often tied to the CPI, usually without new evidence of insurability. The accelerated benefits rider pays part of the death benefit early if I am terminally ill, reducing what the beneficiary receives. The no-lapse guarantee keeps the policy in force even if the cash value is too low, as long as certain conditions are met. The guaranteed insurability rider allows me to buy more coverage at certain ages or life events without evidence of insurability, often ending around age 40. The long-term care rider uses part of the death benefit to pay for nursing home or long-term care expenses, triggered by my inability to perform activities of daily living. Non-forfeiture options are available when I stop paying on a whole life policy, such as cash surrender, which takes cash but may be taxable, ending the policy. Reduced paid-up uses cash value to buy a smaller, fully paid-up whole life policy, allowing cash value to continue to grow. Extended term is the default option, using cash value to buy a term policy with the same face amount for as long as the cash value will buy. Dividend options for participating policies include cash, reduction of premium, accumulation at interest, paid-up additions, and one-year term insurance to temporarily increase the death benefit. Settlement options determine how the death benefit is paid, including lump sum, life income, interest only, fixed period, and fixed amount.